Yeah. So basically, when we started off our discussion, we started off with the very basics of calculus. We talked about the basic concepts associated with calculus, such as function, limits, continuity, differentiability, and from there we started talking about the different concepts of derivatives, maxima, minima, etc. Right after having discussed the very basics of calculus, the next thing that we did was we started talking about. So we extended the basics into from there to the basics of stochastic calculus, right? So we started talking about different concepts like difference equation, differential equations, and what is so when is it that we use difference equations, when is it that we use differential equations, and so on, right? And to that we had incorporated the stochastic term, which was a random error term, because we say that most of the risks from most of the the risks which arise from the market price movements are mostly idiosyncratic risks. They are mostly random noises, and hence this equation. So the moment I entered this epsilon t or this white noise into the difference equation, it becomes a stochastic difference equation. And the moment it becomes a stochastic difference equation, the data generating process of this particular case totally changes, right? And from there we talked about the continuous differential equations. We talked about how is it that we brought in the examples of asset price risk, right? So asset price movements and asset price risks, and how is it that these difference and this differential equation can be used to model these respective risks, right? So basically, we were essentially looking into the so we're looking into the asset price movements. Now, in today's world, right, asset price movements do not happen over discrete time, but rather they happen in continuous time frame, right? For very small changes in the prices, right, in very small delta changes in the prices, asset price movements keep on changing, and what we get to see over there is that they best can be approximated using a differential equation, right? The differential equation that we talked about, the dp by p equals to mu a dt plus sigma a dwat. And over there we introduced the concept of the Wiener variable, all right? Now, basically, one thing that we could clearly see was that whenever we are introducing Wiener processes, or we are introducing a white noise processes, or white noise into a difference equation, or Wiener process into differential equation, what we are trying to essentially do is we are trying to inculcate randomness or stochasticity into these systems, right? Because we know that the volatility of an asset price does not move at a constant rate, but it keeps on fluctuating, it goes up and down. So we need it to be weighted by the changes in the Wiener process. And and that's where we had discussed the Wiener processes, and we saw that this specification of the differential equation of the asset price differential equation, right? So this specification of the asset price differential equation is something which is very tricky in the sense that So this specification is something which inculcates or which brings in the element of uncertainty, the element of randomness into these uh, these dynamics, right, into the asset price, into these market price dynamics. Now, the given that this is a random process, this Wiener process is random in nature, brings the stochasticity. So, what we wanted to understand was that what are the core characteristics of this Wiener variable, right? So, So that's where the question comes in, right? And what we saw was that if we were to explain these stochastic processes, and whenever we are trying to explain these randomness in these asset price movements and all, so what we are trying to essentially do is we are trying to, or we can easily do that by incorporating the normal distribution into them. So we just say that okay, a representative symmetric distribution is a normal distribution, and then these Wiener processes or the white noise, they follow a normal distribution with a mean zero and a constant variance. So we actually talked about why is it that a Wiener process, or why is it that a stochastic, a random term, right? Why is it that why is it that it is characterized with the mean 0 and a constant variance, right? So we saw that if the movement has to be absolutely hypothetical, and if you are unable to identify any trend in trend moving the movements, then what it so the way it must go is it must go up and down at regular intervals, such that you are unable to predict anything, right? So in such a case, the pluses and the minuses they cancel out, and you end up with a summation 0, right? So this is something which is this is something that this is something that we had talked about, and we had also seen that and what we had also seen over here is that the Wiener processes which we talked about, right, they follow a normal distribution with the mean 0 with root t. Now, now we had discussed that this Wiener process was actually a very strong component in understanding the market risk movement or movement of market prices later in a much better manner, right? So basically, when we move on to option pricing, so which we will be very soon discussing, right? When we move on to option pricing, we need to understand this component very closely, right? So the question that so when we had talked about it in a mathematical manner, right? We said that it was a normally distributed variable, and when it was since it was a normally distributed variable, it was normally distributed with mean 0 and root sigma root t and so on. Now, now what was more important for us to understand was why did this happen in a very intuitive manner, right? So because we now need to first of all appreciate what this Wiener process is all about, right? We understand it's there to inculcate stochasticity, but why? So that why is answered over here, right? So in the last class when we started talking about when we were discussing this, so our discussion started with this property of the Wiener processes, right? So how is it a Wiener variable defined, right? So what we are trying to see over here is that this random. So basically, it is there to bring in the element of stochasticity into the model, right? So so how is it that this W or this Wiener variable is defined? So it must be a variable which is defined to be a random variable. It must have certain characteristics of a random variable. So how is it done? So this variable has certain key properties. The first property is that W0 is equal to 0. It means that at time t equal to 0, the Wiener variable takes the value 0. Right? So at initial point, it's at 0. It stands still at 0. So as you can see over here, right? Now it moves. Now let's say this variable starts evolving with time. Right? So the first thing that we need to ensure over here is that this variable cannot evolve with any specific pattern in time. Right? So it says that the increments are normally distributed. Let's say I move from S to T, right? So there will be a certain distance which I have traveled, right? So at Ws, I will be having a certain value of the Wiener variable, right? So let's say at Ws it is S or some S root over or something like that, whatever it is. Now when I move to the next time point t, so basically when I move from S from 0 to S, let's say I am here, right? But that does not mean that when I move from S to T, conditioned on this, you will be able to predict a certain point over here that where I move to. So I can move anywhere here. I can move as a particle anywhere here. I can move anywhere here. I can move anywhere here. So that does not mean, now given that at S, while minor variable at a value, it doesn't mean that when I go to T, I will be getting a value, some value which is conditioned on S, because if there is a progression, right, or if variable, if a particle progresses in a definite fashion, right, then there can be a recursive equation which traces its path. So it says that the differences in WS and WT, right, is the, or the increments that occur between WS and WT is absolutely normally distributed with mean 0 and standard deviation P minus S. So basically what we are trying to say is that when the particle moves from 0 to S, it has some value, it takes some value, but when it moves from S to T, the value that it takes, you cannot actually predict what value it is taking, because the increments between WS and WT, or the increments that it has taken to reach from WS to WT, are normally distributed. So those are different movements, and you cannot actually predict the movement through in recursive equation. And the moment you cannot do that, you know that the variable that you are talking about is a stochastic variable. It brings in randomness. It brings in stochasticity in the entire setup, right? So the next thing that happened also, so the next characteristic of this variable was also that if you have two mutually exclusive time interval, let's say one is between T1 and T2, the other is between T2 and T3. I mean, sorry, T1 and T2 and T3 and T4. Then what you will see is that the evolution, right? So that W T2 minus T1 and T3 minus T4, those two increments, right? So the increments that it makes from move from W1 to W2 and the increments that it makes from W3 to W4 are absolutely independent of each other, right? So they are again normally distributed with mean 0 and a given variance. So any increments at any sub intervals, right, for a minor process is independent of each other. It is absolutely random in nature. So if something is random, right, it's not conditioned on the historic value. So if we think about predictive modeling, right, so why is it that we can model something? Because based on a historical behavior, conditioned on a historical behavior, which is shown by the historical data, we are trying to make a prediction of the next, right? So the next period, next 10 to 12 months down the line, 40 to 20 months down the line, and so on. So basically, when you are doing this, you know that there is a conditional expectation which is working. You know that conditioned on the past, you are trying to frame an idea of the future. But imagine that if all those past figures based on which you are trying to make your prediction becomes independent of each other. So one does not have a binding on the other. Right? So then the entire system would become stochastic in nature. Right? So that is why to understand a random variable, the stochasticity associated with the randomness of the variable is best understood by looking into the different kinds of intervals through which the variable values vary. Right? So that's what we call a typical Wiener process. Right. So after this, the next thing that we did was we explored, we started talking about the asset price movements and the asset price risks, right? So how is it that the asset risk in the asset price starts coming out, right? So one thing was very sure, one thing that we largely talked about in the last class was that when you are trying to determine the asset prices, right? or an asset price or asset holding portfolio is not only indicated or not only represented by the return that it has, right? It's basically represented by two things. One is the returns and the other is the spread of the returns, right? So the average value and the spread. Now the spread, which is called the volatility. So this volatility or this so this volatility is not constant every day. It fluctuates, and hence the dW in that equation, in the dynamic asset price equation, as we can see over here, right? So this is known as the famous Black-Scholes Merton model equation, right, which represents the power of the dynamic asset prices, right? Now the question that comes out is that fine, you have a percentage change in the price, which is your returns. So the price is the returns, assuming that like you whatever is traded, a fair price is quoted, and then the demand is traded, right? But that's not the case. So then generally, uh, so given speculation of given the speculation in the business and like given speculation in the markets, what happens is that in such a case, right? So when you have such a pricing equation, right, and your market is doing great, so what is it that you would want to do? You would want to leverage that to make benefit in your trades, right? So when you're talking about the percentage change in price, mu I dt, sigma dwt, so I'm just talking about two factors that the price, the percentage in price is determined by the average. So that's the average of the basic. So it's the average of the prices that is there, the average price dt plus you have your sigma a weighted by your dt, which is your weighted figures. Right. Now the question that comes out over here is that yes, the percentage in price is totally dependent on the return and on the volatility of the returns. Right. So therefore, it was very important to understand the concept of volatility, and above all, what was most important to understand over here was that how is it that this equation could capture the asset price risk. How is it that we could do this? So this is where we had stopped our discussion in the last class. We had to talk about uh, so we had some discussions about important characteristics over here as well, right? So so what we'll do is we start talking from this point where we see that that So, so when we see that yes, the asset price is going to be fixed, and then we have different other, we have some important variables we will look into and everything. But the first question that comes out over here is that we are talking about market risk, right? And one very important source of market risk is the so basically one very important thing over here that we have over here is that how is it that the risks can be quantified, or how is it that we could identify risks in a mathematical framework, right? And more so because so over here what we're trying to understand is that given that since X movement has a path, or let's say other shopping movements has a path, right? Now when we can how to identify that risk is incorporated within them, right? So how is it that you can do that particular kind of prediction? So over here, what we tried understanding was how is it that this shock is getting incorporated into the model. So the way it really got incorporated over here was we say that okay, the percentage change in price is dependent on the mu A, which is the mean mu A dt plus sigma A dWA, right? So what we are trying to do is we are trying to say that the asset price movement is dependent on the average asset prices and on the volatility of the volatility of the asset which affects the higher management. right? So these are the two broad questions. Now, apart from that, what we are trying to do, we are trying to incorporate another new level, right, which is minus kj. So this is the shock that comes to the passenger change, right? The moment this hits the asset price dynamics, right, what you see is that the asset price suddenly falls. Why? Because this causes a discrete fall in the loop of the assets, right? So this is what we were trying to. So this is the part where we started our discussion in the last class, right? So we had talked about different kinds of business, new business domain. We have talked about some. Uh, so we have talked about some principles, which is, we did talk about some principles which govern the asset prices. Now, what we are trying to understand is that how is it that the risk is incorporated into this asset price movement, because asset price risk is a very critical risk, right? And we are trying to understand the probability, or how is it that what are the factors which would govern the crash, right? And how is it that this crash can be, if not mediated, how is it that we could identify the factors which govern this crash, right? And how is it that we could think about them? How is it that we could manage the risks associated with them? So this is precisely what we were doing, right? In the last class, we talked a little about of creating this, of redefining this, defining this, uh, refining this BSM model, right? Okay, so so coming to your question, Umesh, so what is the crash? Yes, I'll just tell you what is the crash. So okay, before I go into that, just give me a minute. I'll just be back and I'll explain, and we'll get some from there. Hey, hi, Umesh. Okay, so as I was saying, now the question that comes out is that we talked about the asset price dynamics, right? Now the next question that came out over here is that how is it that so how is that risks in asset prices come? Let's say let's rewind back, right? Let's talk about the the Nasdaq in 1995-96, right? So that was the prime time when the U.S. markets was they were seeing the IT boom coming in, right? So with Amazon coming in, with Google coming in. So what started happening was that following that whole genre of innovation, a whole lot of information technology startups started coming in, and they started making their mark. So we have Yahoo coming in at that point of time. We have Google coming in. We have Amazon coming in, and what happened was that and these companies, they started changing the face of the world, right? Now, now with the investor side, on the investor side, we were totally driven mad with the possibilities that these companies would unleash, and hence the prices, the stocks of these prices of these assets, which was listed in the markets in the Nasdaq, started shooting up. So now, what happened was that so the asset prices are just going up, and people all over the world trying to, people all over the US is trying to buy those assets, and the speculation is right at the top, right? And with the American policies at that point of time. So do correct me if I'm wrong. 1996, that time it was the Alan Greenspan era in the Federal Reserve, right? So you had that one whole genre, a set of people playing their role one after the other, and which created a part of exuberance, which created exuberance amongst all the investors, right? And the stock market started soaring up, right? And everyone was buying these assets in a craze, and which was shooting the prices over and over again. But with every lapse of increase in the price, right? So as you see that the investors, so the demand for the asset increases. That increased demand creates an increased enthusiasm. That increased enthusiasm creates an excess demand. That excess demand raises the price. Again, that higher price causes the same chain, right? And that entire thing triggers upward. So in this positive feedback mechanism, which was actually operating at that point of time, right, the asset prices started moving up. So what happened over there? So this mu A was shooting up, right, with every small changes in the time, and this price movement was just going crazy. So basically prices at that point of time, if you plot the Nasdaq, right, or the growth rate prices, the growth rate of the prices, you would see that it totally increased upwards, and then suddenly after reaching a point it just plunged. So when the markets realized that towards the end of so I remember, reading this paper. It was a paper I think published from MIT itself. Uh, I don't remember the university. It was a very good US based university, right? So a paper was published from there that so when they talk about the Federal Reserve dinner, right, where Alan Greenspan talks about the concept of, or he talks about irrational exuberance. And he says that the markets are now being driven by irrational exuberance. So this was just a simple statement which he had made, and it was a very big coincidence that 7 days from that dinner address, all the stock markets started plummeting, and stock markets across the globe had plummeted, right? So this documentation is seen in works of Professor Schiller. You get to see it in works of pharma and all. So if you look into this whole region, it's seen that markets all across the world started collapsing after that statement. So what happened at that point of time, right? So that's where the risk lies. So when you are working with market risk, right, when you're working in the market, you are working with something, with an asset which is not only driven by its fundamentals, but also it's driven by speculation, right? It's driven by the investor sentiments, and one small change can cause a sudden huge plunge in the asset prices, and that's where the role of this crash coefficient comes in, this minus k dj. So minus k is the crash value, right? So I'm saying that let's assume that the crash happens by a given amplitude. So there's a sudden loss of amplitude by k units. And this dj is a dummy variable which says if the crash equals to 1, DJ will take the value 1. If the crash occurs, equals to 0 otherwise. So if you have a look into this, the way these prices has moved, right? So the prices are moving with a certain with a certain movement, right? Suddenly there is a crash which happens, and then the price movement starts changing. So one thing that we could actually see, one thing that comes out to us over here is that the asset prices plunges suddenly, and that's where you lose out your investments. So the moment this crash actually happens and the asset prices slash down, the positive mechanism, the positive feedback mechanism starts going down the reverse way. So basically now, after the prices have fallen, with every fall in price, there is a loss in investor enthusiasm. With a fall in investor enthusiasm, there is a fall in, uh, you know, excess demand. So that excess demand starts turning into excess supply, and that's where you come and end up with a market where people are not willing to buy assets, and that's what your greater food theory talks about. So that at the time of bailing out, right? So there are people who bail out early, and at that point of time, there are these greater foods who buy the asset and they get plunged into that excess supply zone, and they are unable to bail out, right? And that's where the market loses its. So a lot of investment then goes into loss. So that's where the asset price risk comes in. Now, a similar kind of a picture was seen in 2008 with the 2008 with the Lehman Brothers securities, right? So whatever derivatives, whatever assets that they had issued, right? It once the asset was backed by the guarantee of Lehman Brothers, but the moment they had collapsed, they had gone bankrupt, right? The entire world, investors all over the world got caught up with that asset. And when they got caught up with that asset, you knew that it was a huge loss all across the world. And that is where, through the financial channel, most of the world had entered into the global recession of 2008. And that's what the asset price risk, and that's what possibly could be the magnitude of the asset price risk, right? And that's what I'm trying to capture through this the coefficient minus KDJ. The K shows the slump in the asset prices, and DJ shows the crash. DJ is 1 if the crash occurs, is equal to 0. Otherwise, this is called the crash dummy, right? So, is this part clear, Umesh? Perfect. Fine. So now, so this is where the question that comes up. So this is where the part of market risk modeling comes in. Now, whatever I've been talking till now was market risk, right? The question that comes out is how do I mitigate this risk? And number two, how do I predict this risk? So there are two parts to the question now. One is how do I predict the risk, right? That's one. The second is how do I mitigate the risk? That's two. So the first question is of a market risk modeling, and the second part, caters to this part where we are talking about, the market risk management. So this is the part that we need to clearly understand. So I'm saying that okay, fine, there is given that a crash occurs, my asset price would shut down by or it would fall by k units. Now the question that comes out over here is that what is the probability that the crash would actually occur in the next in a forward-looking time? So that is where the key question is. So I need to answer how is it that this market would so how is it that in this market this crash would actually occur? How would I deal with that? So this is precisely So this is precisely the next question, that how do you predict that there is a crash which is there. So if I need to predict that, I need to understand that what are the factors which drive this risk. So that's what I primarily need to understand, right? And this is what we'll talk about right now, and this would be followed by the prediction, right? Okay, fine. So first of all, so the first thing that we need to understand is, yeah. So the first thing is that if the shock had not occurred, right? So basically, what is the probability, right, that the shock will occur in t plus dt period, given that the shock has not occurred up till now? So over here, the first question that we need to answer is that what is the probability? So what is the probability of crash to occur of dj equals to 1, given that it has still not occurred, equal to 1 in, t plus dt period. So what is the probability of dj equals to 1 in t plus dt period? Period, given that, right, given that k has not occurred yet, not occurred yet, given that k is not occurred yet, right? So what is the probability of dj equals to 1? So over here, so what is that probability which tells you or that the what is the probability of dj equals to 1. So this is what we call the crash hazard rate, and this is your ht. So this ht is essentially your crash hazard rate, right? Now the factors which impact the probability will be the factors which impacts this, this crash hazard rate, right? So I will not go into the mathematics associated with this. We'll just look into it from the intuitive side, and then we'll go talk about the prediction techniques. Now, let's talk about this part. So basically what I want to know is that what is the expected value of dj, right? So what is expectation? So expectation or expected value is the average value of a random variable. So over here, your dj is a random variable which can take two values, 1 and 0, and there is a probability associated with each, right? So with this, if dj is 1, the associated probability is ht, and with the probability associated with dj equal to 0 is 1 minus ht, right? ht, and this is 1 minus ht. Well, just give me a minute.
করে দিস আর রান্নাঘরে সব ঠুসেছি ওয়াশিং মেশিন টেশিন সব কি অবস্থায়
Okay, sorry. Yeah, fine. So what we saw over here was that the loss variable is a random variable, right, which takes two values, 1 and 0. Now, given that it takes these two values, right, so associated with each outcome is a associated probability. Now the expected value of dj would be the average value that this dj would take, right? So the expected value of dj, the expected value of the crash, given it has not actually occurred till now. So expected value of dj is, so now we know that expected value of a random variable is nothing but the sum into probability. So over here what we have is 1 into ht plus 0 into 1 minus ht. So the expected value of this random variable dj is nothing but it is ht. So it shows that the average value of the crash dummy or is the probability of the crash to happen in the period t plus dt, given that it has still not occurred. So that's what E of dj shows. Now, when I say this result, so why do I need this result at all? That's the biggest question. So now let's try to link this result to the asset price movement and try to understand the answer to our question. So our question over here was very simple, that what are the factors which is affecting this particular crash, right? So if I can actually identify the factors, then I can actually go ahead and I can identify that then what are the factors which is affecting the crash rate, and then from there I can try to predict that how likely is it that this will crash, or this asset price is going to crash, or the index is going to crash in the next t plus dt period, given that it has still not crashed. So that's what we are trying to show over here. So obviously if you have a look into this, you will see that. So let's try to look into the average price movements first, right? Now, obviously, this you know that this is obviously a random variable. This is the price movement, right? So price variable, the percentage change in price can take many different values with respect to probability. And since it's a continuous movement, so the probability would also be a continuous probability, which is a PDF. So basically, if we want to, so the basic question that we try to answer over here is that what exactly is the expected price movement? So what exactly is the expected price changes? So over here, what we are trying to do is we are trying to find out the average values of these price changes. And the price change is nothing but the returns. So over here, what we are trying to estimate actually is the average returns. So this is the expectation with the expected value. I say that it is mu a dt. Now mu a is a constant value of the asset, a long run average. Dt is dt. Because time is not a stochastic factor, time moves in a given direction. Therefore, I would not be taking an expectation of this variable. So the expectation of this price movement would be the expectation of all the random variables which are there. So obviously, sigma A is again a constant value, which is the long run sigma which is computed. This expected value of dw. So the dw is the change in the Wiener process. Now the Wiener variable changes are independent of each other. So the expected value ultimately is 0 minus k expectation of dj. Right, so expectation of dj is nothing but, so over here what I have is mu a dt. minus k ht, right? So now over here what I can see is that the expected prices are, so the expected price dynamics is determined by two things. Number one, it is determined by your average asset prices, right? It is determined by the movement, by the crash hazard rate, and so on, right? So the next question that comes out over here is that how is it that this particular thing would work out? So what are the relationships that we can derive from here? Now, to derive this relationship between this expected change in asset prices, what we need to do is we need to talk about a particular part over here. Right? So, we need to take it to a point of stationarity. We need to identify the point, that in the long run. So, let's say so if I'm looking into the asset price movements over a point of time, and if the asset prices will reach an equilibrium, then the expected price movements would, or the average price movements over a very long period of time, would gradually tend to zero. So the asset price, as it would reach an equilibrium, the asset price movements would stop, right? So the expected value in the long run, so over a long period of time, let's say as t tends to infinity, expected value of dp by p, so the expected value of the percentage change in price is 0. So in equilibrium in the long run, when the asset prices tend to 0, so this is what it looks like. So this is mu a dt is equal to k ht dt. So, so mu a over here is kht, right? So it shows that the mean returns in the asset over here is driven by two things. One is, so the k is a constant value over here. We are not introducing distribution on this. So the main factor which drives up the mean returns of the asset is this crash hazard rate. So the mean return, so in an asset price movement which has the chances of crashing, right? So if you introduce a dynamic crash parameter into it, you would see that the mean returns in the asset is controlled by the crash rate. So the crash hazard rate controls is a control parameter, as we can say. The crash rate controls, or is the control parameter is the control parameter is the control parameter of mu a. So now, this is, now even though, Mesh, it may seem that it is a lot of theoretical calculation which have gone in, but so I'm more interested to interpret the result over here, right? So if you look into this, you will see that this mu a that I am talking about over here is the mean returns of the asset, right? And now, if there is a crash parameter related to it, what I'm saying is that the higher the crash parameter is, higher is the mu A, or the mean returns of the asset. So now just try to think, try to think about it. This crash parameter may not be directly perceivable to us, but when we see that the asset prices or the mean value of the asset prices are increasing constantly over a period of time, and they are increasing very rapidly over a period of time, that is where we understand that yes, this asset price is gradually nearing a crash. So basically, a very simple way to understand this is that you take the historical mean returns of the asset over, let's say, the last 100 years, which is available with you from your index data, right? So if you compute the average returns on over different time periods, right, and you look into the 5 years, 10 years, 15 years, 20 years moving average, right, so you'll get a trend. And if you look into the most recent changes, the mean returns in prices, right, and you compare the two, then you would see that how quickly is it that these asset prices are moving now on, or in the recent past. So if that is happening, then you know that you are gradually moving to a crash. So the higher the crash hazard rate becomes, the higher is the mean returns, right? So if your mean returns, or vice versa, if I am to say that, if the mean returns of your asset is to escalate very quickly, then you know that yes, this asset price, so I'm gradually nearing a crash, right? So it is this crash hazard rate which would actually is controlling your mu A. And now if you think about it intuitively, with this crash hazard rate, this escalation of the mu A prices is linked because of that feedback pattern that we had discussed, right? So the stronger that feedback pattern is, the higher would be the return, higher would be the excess demand, hence higher would be the return from the asset prices, right? But at the same time, the market gradually nears a state of market correction. And when it hits a terminal price, then the market correction happens, and you suddenly realize that you are actually paying too much for that asset, and then the asset price collapse actually happens, right? So this relationship is a very critical factor. So you can see that you have to control the risk, right? So I can easily control it. I mean, not easily control it, but one method or one index of looking into it would be the extreme or fast rising average returns. So the average return from your stock rises very quickly. So let's say your stock takes around 6 months to give you a additional return or an increased return of 10%. Right? So let's say previously you were on making a return of 3% from your stock, right? Now you are making a return of say 3.8 or 3.10% from your stocks, and for that increase to happen, for that additional 10% for you to get the additional 10%, right? You should you have to wait for the next 5 6 months, right? Now what you see is that you are getting that same increase within 3 weeks or 4 weeks time, and then the subsequent increases are actually increasing exponentially. So if your returns are growing at a growing rate, then you know that you are gradually moving towards the stock, you're towards a particular crash rate, right? You are nearing the ceiling price of the asset very quickly, and the market would be undergoing a correction. So similar cases, right, has been observed for these cryptocurrencies. So when these bitcoins came into play, right? So at that point of time, if you recollect, Umesh, you would see that those prices were growing very fast, right? Given that, even given the fact that they were limited in numbers, right? So they were fixed in numbers. So given that, but after a point of time, the prices have slashed down. So any asset whose price grows very fast, like relative to the average, you know that the market is going to hit a ceiling, and after that, the change is going to come in. So this is precisely the challenge of these assets, right? right? So is this part clear? Okay. Okay, so let's do something. Let's take a quick pause over here. Let's take a 10 minutes break. Or yeah, it's 7:15, 5:15 by my watch. So we start again at 5:30, right? So Umesh, in the meanwhile, you can just go through the just you can look through it. Don't worry about the mathematical nature of the equation. Just check whether the interpretation is clear to you. So whether the intuition is clear or not. Because as we go, as we go forward, some mathematical equations would be coming down here and there, right? So it will take some time for you to get accustomed to it, because that's a very big challenge with market risk, right? So it's highly quantitative in nature. So we'll gradually go through it. You go through the equation, just check whether you have any queries or not. Think through it, right? So take some time, think through it, and then we'll get started in a while once again. So just take some time and go through it, and we'll start. Okay, okay, fine. So did you go through that the expression? So okay, so let's start it from there itself, right? So just first tell me something. Are you aware of this concept of expectations of a random variable? So you need to understand two things to connect this. First is you need to understand what is a random variable, right? So you know that, right? So a random variable is a variable which takes multiple values, and associated with that multiple values, with each of the values you have uh, what should I say? So you have a probability associated with them, right? Okay. Okay. So now tell me, do you know what do I mean by the expectation of a random variable? How expectation is computed? Do you know that? Fine. So let me just clarify that part, and then I'll talk about a concept called equilibrium. So once these two are put together, then you will get a rough idea. You'll get the idea of what I'm trying to do over here. Right. So before I go into talk about the random variable, let's just talk about something. Now this is something very basic, right? And this is one of my very favorite areas. So that's called equilibrium, right? So we all know about demand and supply, right? So so like in commodity market, right? When we are buying goods and services, we create so when we buy goods, right? So every good comes with a demand, right? So I have the quantity of a good, and I have the price of a good, right? Now what happens is I will draw the demand curve, right? So what is a demand curve? A demand curve occurs when with an increase in the quantity demanded, so as you know, As the price of a commodity goes down, the quantity demanded increases, right? So therefore, there is a negative relationship between demand and price. You agree to that? And the supplier or the supply of the good increases as the price increases, because with an increase in the price of a commodity, the profit that the person to the revenue earned by the producer would be more, right? And where the price, the demand and the supplier's price intersects, right? So that's what we called the equilibrium price, or in finance, the term that we use is the strike price, right? So this is P0. This is Q0. So now with P0 and Q0, right, what we have is an equilibrium price. Now what happens at an equilibrium? Now when you reach an equilibrium position, when you reach, okay, so over here, when so where the price reaches an equilibrium, right, the price stops moving, right? So the equilibrium point is called a point of invariance. So what happens is, you agree at a price, I agree at a price, and the price stops, right? Now let's say that you quote a price, I don't want the price, so there will be a disagreement, right, and the price would move. Now, what generally should happen is that in the short run, or when the adjustments begin, so quantity demanded would increase and go down, increase, something like that would happen. The prices would fluctuate. But the point where you and I reach a common point, we reach a point of cognizance, or you and I agree to a given price, the price movement stops, right? And that becomes the equilibrium. Correct? So let's say, let's take this price, a price over here, say P1. Now at this price, the quantity demanded is this much, right? And the quantity supplied is this much. So obviously, the supply here is more than the demand, and that is where you have excess supply. Now with an excess supply, what would happen? The price would go down, because the producer has supplied more, right, and the demander is not demanding. So the producer sees that at a given price he cannot sell the good, so he cuts down the price. So, and hence the price starts moving downwards, and it would move downwards until and unless this equilibrium price or this strike price is reached, right? So gradually it will move down like this, and it will come to the strike price. Similarly, if I look into this graph, right, so this is where the supply is. Let's say I have a price which is over here. Now the price that I am charging is much lower than the price which the market is willing to pay, right? Because I don't know what that actual price is. So what would happen over the long term? this prices would gradually increase, right? And it would gradually start moving towards the strike price. So when I see that at this price there are many more people who are willing to buy, I raise the price a little bit. I see that yes, the number of people are willing to buy is more, and then a point is reached where the price that I am charging and the price that they are willing to pay is the same. Now after that, if I raise the price, I know that the demand is going to fall down. So over here, this situation is called the excess demand. Excess demand, right? So excess demand will cause the price to rise up and ultimately reach your strike price, right? So are these two parts clear? So similarly, when we are dealing with assets like a share price or the price of any asset, right, it follows a similar rule. So it is driven by the excess demand and the excess supply, right? Just imagine, let's think about a very weird case in. Okay, so let's go back to our housing crisis, right? The subprime bubble. So the subprime housing crisis. Now, what happened in the housing crisis? So, initially, if you think about the housing crisis framework, you will see that with immediately after the World Trade Center collapse, when US entered into the crisis, US entered into a downturn. What US government did was, or what the regulators did was, they cut down the consumption loan, the interest rate on consumption loans to a very low level. So to a level of 1%, right? So when that happened, people started buying more and more amount of goods, right? And there was a huge inventory which was piled up because of the downturn, which was cleared, right? Now, when people are buying more and more goods and services, the economy is gradually expanding. So people's incomes are increasing, and with that increased income, what they are trying to do is they are trying to buy more, and so they're trying to invest it in real estate, and hence the housing prices started increasing, right? But after a point of, so as long as the housing prices were increasing, why was the increase there? Because the supply of the housing was much more than the demand, right? And then suddenly people realized that the housing, the prices that they are paying for their houses is much more, is very large, or it's very high compared to what they should actually be paying. There was a market correction, right? And then what it resulted was in an excess supply. The moment the excess supply happened, housing prices started crumbling down, right? And you are left with an excess supply of those assets. So now, whenever I am working in a market, what is my objective, or what is it that I should be doing over here? So what I should be essentially doing is the following. I should be looking to create, I should be kind of looking to create a so what should I say? So I should be looking to create a equilibrium, right, in the long run. So basically, a point where my economy should be going to a point where the demand equals the supply, and I am at an equilibrium price, right? My economy has an equilibrium price and equilibrium quantity, and my markets are in an equilibrium. So that's always a long-term movement. So what it means is that all excess supply and excess demands would cancel out, and my economy would reach an equilibrium point, right? So that's a long run equilibrium that we generally talk about. So this is that long run equilibrium condition. So what this equation basically says is that in the long run, when the asset markets, so for an asset market which has reached an equilibrium, right, the mean returns or so if the long run, for the long run market to reach, for the long run asset price market to reach an equilibrium, and which has this kind of a dynamics right over there, the mean return is always controlled by the crash hazard rate. So this is called the long run equilibrium, or this is the long run equilibrium condition. So whenever you want to whenever you want to assess certain properties or certain relationships between variables, right, you need to drive an equality, right? So that's why it is solved at equilibrium. So what would the conditions be if the market was in an equilibrium? So you know that, so when the market when the price movement stops, right, and you want to know that what are the factors which is driving the mean returns of the asset in that market, it is the crash hazard rate, right? So this is what the long run, so this is the long run equilibrium condition. Now comes the next question over here. What is this expectation? What is this expectation of dp by p? So dp by p is nothing but the percentage change in the price, right? So now comes the question that what is an expectation of a random variable? And so let's say I have a random variable, right? X. So X is a random variable. I'll write it as R dot V dot. Now this random variable has multiple outcomes. Say X1, X2, X3, like this, right? Let's say each of these outcomes, X1 has an outcome F1. So X1 occurs F1 number of times. X2 occurs F2 number of times. X3 occurs F3 number of times. So that means X1, the number of cases favorable to the occurrence of X1 is F1. Let's say X1 occurs 10 times. So that means the number of cases favorable to the occurrence of X1 is F1, right? So this F1, so now from this I can actually compute the likelihood of X1 to occur. So probability of X1 to occur is F1 divided by all the possible outcomes, right? X1 to occur, X2 to occur, and X3 to occur. So this is F1 plus F2 plus F3 to occur. So that means the probability of X1 to occur is F1 by capital N. So this capital N is nothing but the summation of the three frequency distributions. Clear? Got it? Perfect. Now what I want to do is, now for this series, if I want to find out the mean, I want to find out what is the mean value that this variable x takes. So what do we do? It is x bar. So x bar is what? How do we compute the mean? Mean is the total of the values divided by the total number of observations, right? So this becomes f1 x1 plus f2 x2 plus F3 X3 divided by the total number of observations, which is F1 occurs, if X1 occurs F2 F1 times, this is F2 plus F3. So is this one clear? Say X1 has occurred F1 times. Let's say X1 has occurred 10 times. So the total sum of that will be X1 into F1. X2 has occurred F2 times. So it's X2 into F2 like this. So this is nothing but, if you see, this is nothing but capital N. So this becomes F1 by N X1 F2 by N X2 and F3 by N into X3. Right? X1, X2, X3. Right? So now if you have a look into this, you will see that this is nothing but the probability of X1 to occur plus the probability of X2 to occur plus the probability of X3 to occur. Right? So therefore what you can see is this is nothing but the sum product of probability of outcomes into xi. And this is precisely what we call the expectation of the random variable x. So this means this is nothing but the average value that a random variable can take is called the expected value of the random variable. Clear? So what we are saying in this equation is that if you observe the asset price movements over a long period of time, over a substantially long period of time, the average return that you will expect from the asset should be zero. Why? Because we expect that over the long term, through multiple adjustments in aggregate supply and demand, it would reach to a point of equilibrium where there would be no possible movements, and hence the average value of the return in the long run would tend to zero. So if this happens, it means that it vice versa means that the asset has reached a point of equilibrium, right? And if it when it is there, right, one very critical thing that we can observe here is that the mean returns of the asset is controlled by the crash hazard rate. So this is precisely what we are trying to say in these two lines. Now, are you a bit comfortable with this explanation, Umesh? Perfect. Perfect. Excuse me. Fine. So having discussed this particular thing, the next question that comes to our mind is the following. So what is the factors? What are the factors which control? So over here I get to see that the mean returns is controlled by the crash rate. But what are the factors which would control the crash? Because if I can predict the crash, like the probability, if I can estimate the probability of the crash, then given this equation, given this equation, I can find out that what should be the mean return or the interval of mean returns where I should expect a crash, right? So what are the factors which affect this? Now this is something which is very interesting. Now the crash hazard rate is impacted or is explained by two things. Number one, it is explained by herding behavior, the tendency of the the investors to herding behavior, and the second part is from the critical time of crash, from the critical time, the critical time TC. So this TC is a critical time, right, around which the crash tends to happen. So what happens is every time, with time, as the asset prices and speculations progress, this T keeps on tending towards a terminal time TC. So this TC is the point by hitting which, when it hits that time, right, that, so at this critical time, the asset is assumed to reach its peak. And once it hits that point, a crash occurs at that point. So the closer this, as you come closer to this point, right, TC, right, your crash hazard rate increases. Now the question is that theoretically it sounds fine that you have a TC and everything is there, but how do you estimate in practical life or in real time? How do I estimate it from the data empirically, right? So that's the next important question. And how is it that I would capture this herding behavior? Because if I can estimate this HT, I can predict what are the probability of the crash happening in the next 12 months. So the next question that we need to address over here is, how is it that this crash hazard rate can be estimated? What are the distributions which will help me estimate that, and so on, right? And from here we move to the next question, that how is it that this asset price risk can be managed? So these are the two questions that we address in tomorrow's class, right? And then we'll talk about the statistical methods which can be used to do that prediction. So this is one specific case where these things come in together. So this is how an asset price risk is actually generated, right? So thank you, Umesh. Thank you for your time today. Let's catch up tomorrow. And yes, so this will take some time, Umesh, because this needs to be converted, right? So I still have the morning sessions getting converted right now. So once I'm able to convert it, I'll put it up in the folder, right? Okay. So thank you, and I'm trying to get this class down on Sunday morning, Sunday 7 to 9. Now let me talk with Tom a little bit, and then I'll get with it, right? Fine. So let's see if we can work that part out. Okay. So thanks, Umesh. Thanks a lot, and let's catch up tomorrow. Bye bye.